My name is Simon Brugger, and I'm a director within Golding's infrastructure team. I've joined the firm in 2014 when the asset class infrastructure has just been introduced at Golding. And since then, we've grown substantially and now manage over 6 billion of infrastructure assets through primaries, secondaries, and co-investments. Volatility has indeed increased across various asset classes since 2020. First, with the COVID crisis, and in 2022, with the cost of living crisis following the brutal attack of Ukraine. So it's probably fair to say that we are currently coping with a more uncertain macro environment than 3 years ago, with supply chain disruptions still stemming from the very restrictive lockdowns in China and inflationary pressures, which we are all feeling in our daily lives. Now, if I look at our Golding infrastructure portfolios, overall valuation levels didn't experience a substantial amount of volatility throughout 2022. So while I would still say that infrastructure presents substantially lower volatility compared to other asset classes and shows quite some resilience, I'd also say that the asset class is not completely immune against the macro backdrop we are experiencing right now. Investors don't like uncertainty, and the root of the currently high uncertainty levels is inflation. We got used to over a decade of very low inflation and very low interest rates, and have been investing with a view that this probably wouldn't change anytime soon. And I would say even central banks were caught by surprise by the steep increase in inflation in late 2021, early 2022. We had a perfect storm of an overheated job market, supply chain disruptions, and the war in Ukraine, which, besides the very negative consequences for Ukraine itself, has led to a gas shortage in Europe. And ultimately, also the sanctions contributed to the inflationary pressures. So what has happened as a consequence? Central banks started hiking interest rates sharply, which had a wide impact across most asset classes. Stock market valuations came down, fixed income and bond markets as well. And the steep decline in bond valuations has ultimately led to a number of banks, both in the US and in Europe, getting into serious troubles recently. So that's where we actually see the volatility in the valuation levels. With regard to private markets, buyers are having difficulties to value assets because they need to form a longer-term view on both inflation rates and interest rates. And that's an issue impacting the broader private market space, but also infrastructure assets in particular. So infrastructure investments are largely affected by three factors. Number one, greenfield, or especially greenfield projects, are experiencing higher capex levels from an increased inflation. So the cost of building a wind park, for instance, has increased by roughly 20 to 25% when compared to 1 year ago. And this obviously tends to have a negative effect on return levels. Number two, financing. Financing became more expensive given the higher interest rates, and also the amount of available debt might be reduced compared to what we've seen 1 year ago. And also here, the overall effect tends to be negative on return levels and valuation levels. And number three, and that's really the big question, is what happens to your revenues? And that's probably where infrastructure can show its resilience over other asset classes. Infrastructure assets oftentimes have inflation-indexed revenues, meaning for many infrastructure assets, the top line increases in line with inflation. And for a number of assets, think especially of renewable assets, the extreme energy prices we've seen throughout 2022 have actually been strong tailwinds. Now, in order to value infrastructure assets, you need to form a view on all these three factors. So especially the equity valuations of assets which are either heavily levered or don't have a good inflation linkage in their revenue profile are the ones most under pressure. And these types of assets contribute to the perceived volatility. That being said, there are a number of infrastructure assets which are very resilient in the current environment given their strong inflation protection. We have for example, an energy from waste asset in our portfolio, which has inflation-linked gate fees for the acceptance of waste from the communities, and can ultimately sell the generated power at higher prices. So it's coping really well in this environment and can probably even benefit from the high inflation levels. Summarizing, it's probably fair to say it really depends on the underlying asset, how volatile its performance and ultimately its valuation is going to be. A fund of funds' main strength is diversification. And our Golding fund of funds target more than 200 individual projects across the entire risk-return spectrum from core plus, and value add. And should hence substantially reduce volatility stemming from one particular asset, referring to the example I've made earlier on. So even more so, we are building well-balanced portfolios across sectors, trying to avoid an overweight to any particular sector, such as digital infrastructure or transport. And that's also the reason why our infrastructure portfolios navigated quite well through the COVID crisis, because we didn't have an overexposure to airports, for example, which were heavily impacted by the travel restrictions and the reduced passenger numbers in 2020 and 2021. We are also trying to contain greenfield exposure to just 20 to 30% of our portfolios, which reduces our exposure to the broader capex inflation I've mentioned earlier on. And lastly, next to our primary fund investments, we are investing via secondary transactions, which allows us to better diversify also in terms of vintage years over a broader time horizon and smooth our yield profile. So our fund of fund is a great product for investors starting to build their infrastructure allocations who want to immediately gain access to a broad portfolio of assets, which is well diversified across sectors, regions, and project stages, and provides a good level of resilience. Next to our fund of fund offering, we have also a co-investment product where we are investing in single assets with blue chip infrastructure GPs, by adding a second layer of due diligence and being very selective with regard to asset quality. And this rigorous approach has led to top quartile returns for our first co-investment fund, which is a 2016 vintage, even when you compare it to direct infrastructure funds. And while the number of assets is lower than in our fund of funds strategies, think of more in the region of 15 assets rather than 200 plus, as in our fund of fund, it's still a well-diversified portfolio in terms of sectors and geographies, but also in terms of different GP partners. So our co-investment product could be an ideal addition to a pre-existing infrastructure portfolio, adding exposure to a number of different GPs and sectors, while at the same time maintaining a high degree of selectivity from this second layer of due diligence I've mentioned.